This video is for lesson 2-1, which is using T accounts. In this lesson, we will show the relationship between the accounting equation and a T account. We will identify the debit and credit side, the increase and decrease side, and the balance side of various accounts. And we will restate and apply the two rules that are associated with the increase side of an account. So in Chapter 1, the effects of transactions were recorded in an accounting equation. This procedure is not practical in an actual accounting system. Because of the number of accounts used by most businesses, recording transactions in the accounting equation would be cumbersome. Therefore, a separate record is commonly used for each account. The accounting equation can be represented as the T shown on this side, where our assets on the left side of the equation need to equal the right side of the equation, which is your liabilities plus owner's equity. This always has to be in balance, otherwise we did something wrong. A record summarizing all the information affecting a single item in the accounting equation is known as an account. Transactions change the balances of accounts in the accounting equation. Examples of accounts that we have used before would be our owner's capital account, cash, supplies, accounts receivable, accounts payable, and so on. Accounting transactions must be analyzed to determine how account balances are changed. An accounting device used to analyze transactions is called a T account. There are special names for amounts recorded on the left and right side of an account. An amount recorded on the left side of an account is called a debit, and the right side of their T account is going to be a credit. Now, the words debit and credits come from the Latin and Italian words debere and credere. Common abbreviations are DR for debit and CR for credit. So we get the DR for debit even though there's no R, just because it comes from the Latin word that it comes from. In an accounting system, the terms mean only the left side or the right side of an account. Debit means an amount is recorded on the left side of an account, and credit means the amount is recorded on the right side. So these are two separate T's that are drawn. We have up here the top one where our assets have to equal our liabilities plus owner's equity, the right side, and then separate T account here because they're not related. Don't think that like assets are always debits or liabilities and owner's equity are always credits. Our separate T account here is just showing that when we record transactions, anything recorded on the left side of our T account is a debit, and anything on the right side of our T account is a credit. So increases, decrease, and balances in accounts. So for assets, on the left side of an accounting equation is going to be their normal balance. And a normal balance is the side of the account that is increased. So assets have a normal debit balance. So if we were to receive cash, we would give it a debit. If we were to pay cash, that would be decreasing our cash. That would be a credit. Now, liabilities and owner's capital accounts are opposite. They increase on the right side, which means their normal balance is going to be a credit, and then they decrease with a debit. Liabilities, owner's capital account, those would be the ones that we have used so far. So looking at our T accounts here, any asset will have a normal balance on the debit side, and the normal balance is always the side that increases. So for cash, we would increase if we received cash. We would record that on the debit side of the T account. Whereas if we were to pay cash, that would be decreasing our cash, and it would receive a credit. Now that's the left side of our equation. On the right side of our equation, any liability, which is our accounts payable, is going to have a normal balance of a credit. So if we were to buy supplies on account, the amount we would owe our accounts payable would increase with a credit. When we pay that accounts payable, it's going to decrease with a debit. And then we have our owner's capital account. Say if they were to invest money into the business, we would record that on their normal balance credit side, and then they would decrease with a debit. T accounts are something that will always be useful in accounting. We won't always record our transactions in a T account. We will use journals instead. However, when I took my 200 level accounting classes, my professors at college would draw T accounts on the board to just illustrate our transactions. So they are important to learn and to know, and it's something that I will draw and use while teaching this class throughout the year.